Hey everyone, we're going to take a quick look at Newegg since it's been acting very strangely the past couple of days, and we're going to try to figure out what exactly is happening because honestly, a lot of it doesn't make sense. But remember, this is not financial advice, just my own thoughts and opinions. Um, So, quick recap. Newegg is a e-commerce company that focuses mainly on computers, computer parts, and electronics. They are based out of the City of Industry in California. And Newegg was normally trading about a week ago, 2 weeks ago, around the $10 range. And a lot of people would say this is the kind of standard price. We're looking at $10, $10, $10. So consolidating there and holding there for quite a long time. But recently we saw a jump up to the 15, a little bit under $20 range, which lasted for a day. And then it went up to the mid 20s about 2 days later. And then finally it made a huge spike. I believe the peak was at 79, which was on July 7th, so 2 days ago. And just by looking at this, it looks like a classic pump up to here. They did have a news announcement, a catalyst, where they will be building custom PCs with parts that you order, but that would not justify a jump up to the 70s or 60s, which is a 3 to 4 times jump. This company is successful, I would say, but they are a little bit financially unsound at this point. They're not making a ton of money, and they are working in a part of e-commerce with very low margins, and also a part of e-commerce where you don't have much customer retention in the fact that most people are not ordering computers or computer parts uh, daily, weekly, or monthly like they would be ordering stuff from Amazon. I myself use Newegg whenever I build a computer, and I will use them probably once every 2 to 3 years when I need to build a computer. So it's not a company where you are getting a lot of revenue from a single customer throughout the course of a year or even 2 years. Yes, when they do make a purchase, it will be a big ticket item, but it will just be that one time. All right. So we see the pump here, which looks like a normal pump. We had people buy in, and then we had a sell off for profit. And then once they realized it wasn't going to drop too much further, they kept at it, peaking and then ending the day at a fairly high price of around $60. So when most people saw this, a lot of investors recognized it as a pump and dump or thought it was a pump and dump, so they bought puts into this position, expecting a steep drop off the following day or the following few days. When we get to the next day, we do see a drop off above about 30, 32%, I think, was what it ended at. But we don't see what is normal. We might see like one or two attempts to regain some momentum, but usually from here we will see another sharp drop off, which continues to the next day. Instead, what we saw was that the following day we saw another spike. This one up to $59. I believe at some point during the day it was all the way up to $60 or beyond 60, which again does not mirror what happens with a normal pump and dump. Another strange thing is that the volume that brings this price to higher highs, or I guess higher mids, not really high since it's not going back up to 70, but these volumes are exceptionally high for something that is a stock that the volume is not that heavy. Um, so seeing 1 minute candles of 600,000 there, 700,000 there, 1.5 million, another million. these are not natural candles for this type of stock, especially when volume is low. You are not going to get, even if the average retail investor is buying 100 shares, which is quite a lot for a $60 stock, you're not getting 10,000 of them to suddenly all decide to buy at the same time. So this is going to be for buys by institutions, hedge funds, people with a lot of capital. So why would they want to keep this up in this price point? It was trading between about 45 to 55, I think. Why do they want to keep it in this range? I think they are all smart enough to recognize that this company is not worth this much. So why are they buying millions of shares? This morning, in the first 2 minutes, over 2 million shares were purchased after it had been kind of flatlining in the aftermarket and pre-market. Volume was exceptionally low during those times. So retail investors at that time had kind of lost interest, I would say. But we see those two big buys. Now, this was something that I was kind of racking my brain all day on why they would do this. So the conclusion I came to was probably with the options. So we're going to look at the put options. Let's see, show. I guess I can't show everything. But for this particular stock, up until yesterday, the highest strike price was $40. So fairly low. And currently, all of these put options are out of the money. We'll pretend that $40 is here. $40 is also out of the money. New options were added, I believe, yesterday, and they continued on today. So for certain hedge funds, this was a stock that they were shorting. And I think when this initial run-up happened, they were probably caught off guard, and they probably lost a good chunk of money here. So, but they also understand the psychology of things, saying that whenever there's a pump, a lot of people are going to be buying puts because they're waiting for the dump. Now, we'll use Citadel as an example. Citadel is a company that does both shorts. They also do longs, and they will also do market making, which is writing options. So with this volatility on the first day, prices for puts was fairly high. So they were able to write a lot of puts with very high premiums. We're talking for a $40 put at the strike price of $40, they were probably charging $800 to $900 or $8.90, $9 per contract. So $890 to $900 per contract. And then the main thing with selling options is the higher the volatility, the better, the higher the price. So higher volatility means that you are getting a lot of price action. So the following day, you see a 33% drop, which again increases volatility. A lot of the people who bought puts during this time, they were caught in IV crush. But for those puts to actually be worth something at their end, which is on the 16th, the price has to go below 40. So we'll look at the options again. The price above 40, all of these options will be out of the money, including the $40 one. So I think that it is in the best interest, whether they're actively doing this or not, it is in the best interest of market makers and these hedge funds to keep the price above 40. So I think that is what they are doing. They are pumping up the price to keep it above 40. And there are, of course, still retail investors involved who are looking at that and saying that, the price will go up. I've seen estimates of 100. I don't think the market makers need it up to 100. Again, they just need it up to 40. So expect this next week to probably maintain that 45 to 50 range, I would say. Every time it dropped to under 45, There were big buy orders to protect the price and prop it up to keep it from dropping any further. This is kind of a weird one. This is not your typical pump and dump in that sense, but right now, pretty much um, most retail, I would say, is losing money on this every which way. So people who are buying call options are losing money because they're buying expensive call or higher strike price call options, probably like 45 plus, which will probably be out of the money because those are the cheaper ones to purchase. And people who are buying puts, they are out of the money and they are losing huge amounts on their premiums. And you have retail investors. I believe the average buy price last time I checked was about $52. So they are at a loss as well. So where's all that money going? It's going to the hedge funds. This is kind of a video I didn't want to do, mainly because I don't believe in conspiracy theories. I think some conspiracy theories can definitely be true, but until I see some evidence or some really good reasoning behind it, I will tend to dismiss it. But this is just something that makes too much sense for a hedge fund market maker to do, because this is something they could do on their own, and this is to protect their interests. And everybody is saying the shorts are gonna burn on this, or the shorts have these huge fees. And yes, they do have higher fees for so far 2 days, maybe up to 2 weeks. But in the end, they're making so much money off of this play of burning the options holders and burning retail investors, because this will eventually dump. I think, at the current situation, they'll probably come out of this with a profit. So just be careful out there with this. Newegg is kind of like a ticking time bomb for everybody, because if it does hold the current price, those who are holding options, whether they're calls or puts, a lot of them are going to be burned. If it drops, it's going to burn a lot of the retail investors who are caught up in the FOMO and who see this price action and think that there is still a possibility of an upwards trend. Just think about who has the most to gain, who has the most to lose, and who is kind of emotionally locked into their positions and those who are not. All right, again, this isn't financial advice, and hopefully, a lot of you guys did make money off of this initial rise, or maybe swing trading here, but again, be very cautious. Thank you and have a great weekend, guys.